The stock market can go up for 10 straight years, and you can still finish behind the return on the chart. Not because you picked a bad investment, not because the market was rigged against ordinary people somehow. You can own genuinely good investments during a strong market and still earn far less than the headline return. Here's the distinction that explains it. A market return is what the investment produced if simply held untouched. An investor return is what the actual person earned after buying late, selling scared, or switching funds mid-cycle. Those two numbers are frequently not the same, and the gap between them is where most people quietly lose. Morningstar studied this gap directly. Over the 10 years ending December 2024, U.S. mutual funds and ETFs returned 8.2% annually, but the average dollar actually invested in those same funds earned only 7.0% per year over that decade. 1.2 percentage points doesn't sound dramatic on its own. Compounding is what makes that small gap expensive. $10,000 at 8.2% for 30 years grows to roughly $106,000. The same $10,000 at 7.0% grows to about $76,000. Same start, $30,000 missing. The fund did its job. The person holding it did something else, and that something else has a price. Sometimes the gap is much wider than 1.2 points. Dalbar's 2025 report found a striking example. In 2024, the S&P 500 returned just over 25%. The average equity fund investor earned 16.54%. 16.5% still sounds like a great year, but the market handed out a bigger one, and most people didn't fully collect it. The following year told a different story. Dalbar's 2026 report found the S&P 500 returned nearly 18%. The average equity investor earned 17.16% that year, a gap of well under 1 point. That's actually encouraging. It shows this gap isn't a fixed law. It moves with behavior, volatility, and how much people interfere. In other words, the gap isn't only about what the market does, it's largely about what people do in response to it. Picture two investors, same starting fund, same low-cost S&P 500 index, both calling themselves long-term. The first sets automatic contributions and mostly leaves the account alone. When prices fall, the plan keeps running quietly. The second checks the balance every morning. Prices rise, and he adds more, feeling behind. Prices fall, and he waits for clarity. When a hot fund dominates the headlines, he moves money toward it. When that fund cools, he starts hunting again. They may own nearly identical investments, but they will not earn anywhere close to identical returns over time. One owns a plan, the other owns a mood. And moods are expensive things to manage a portfolio with. The market doesn't climb in a straight line. It climbs more like someone walking upstairs during an earthquake. There's real progress. It just rarely feels like progress while the shaking is actually happening around you. A normal year can include scary drops, recession headlines, rate fears, election fears, and a chart online predicting collapse. The problem was never fear itself. Fear is a completely normal, reasonable response to watching your balance drop. The real problem starts when fear becomes an actual trading strategy instead of just a feeling you sit with. Someone sees a 15% drop and thinks, I'll get out until things calm down a little. But markets don't send a calendar invite before recovering. The rebound often starts while headlines still sound terrible. By the time it feels safe to buy again, prices may already be significantly higher than where you sold. So the investor who sold to avoid pain now faces a second, harder decision. Exactly when to buy back in. That second decision is genuinely tougher than the first because cash starts to feel safe once you're holding it. Buying back into the market can feel like publicly admitting the first move might have been the wrong one. So the investor waits. The market keeps rising. And waiting starts to feel more painful with every passing week. Eventually they return. Not because the plan improved, but because missing out finally outweighs the fear of losing money. That's how people sell low and buy high without ever once intending to do exactly that. Nobody wakes up and says, today I'll sabotage my own retirement. They say, I'm just being careful right now. They say, I'll wait for a better entry point. That phrase alone has cost investors real money for decades. The opposite mistake happens during bull markets, when rising prices quietly get mistaken for personal investing skill. A fund jumps 40%. The story is suddenly everywhere, and money floods in right after the big move already happened. That timing matters enormously. A fund can post an excellent 5-year return while most of its investors bought in late. You can own a genuinely good investment and still have a bad personal experience with it, not because it failed, because the entry timing was wrong, and timing is exactly what turns a good asset into a disappointing one. Morningstar's research found something consistent here. The more investors traded, the worse their actual dollar-weighted returns tended to be. Volatility made it worse too. The more emotionally difficult a fund was to hold, the less of its return people captured. That tracks with real life. Big gains create greed. Big drops create panic. Every emotional swing invites another impulsive action, but investing usually rewards the opposite of action. It rewards boring repetition, steady buying, occasional rebalancing, low costs, patience. That advice sounds simple enough to feel almost insulting, but simple has never been the same thing as easy. In 2025, S&P Dow Jones indices found that 79% of active large-cap U.S. funds underperformed the S&P 500 that year. That doesn't mean every professional manager is bad at their job. It means beating the market is hard even full-time. Now compare that to someone trying to beat the market part-time between a job, bills, a family, and daily headlines. The real question was never, can someone beat the market? Someone clearly can, at least for a stretch of time. The real question is whether your entire financial future depends on you being one of the rare few who can. That's usually a bet people make completely by accident without ever framing it as a bet in the first place, because underperformance rarely announces itself loudly. It hides quietly inside a string of individually reasonable feeling decisions. It hides in the fund you sold right before it recovered, in the contribution you paused for 6 months. It hides in the cash you kept waiting for a crash that simply never arrived on your schedule. It hides in the hot fund you finally bought after everyone else had already made most of the actual money. It hides in the retirement account you keep meaning to rebalance every year without quite getting around to it. It hides in the gap between the return printed on the chart and the return that shows up in your real life. Most investors don't actually need better predictions about where the market is headed next month or next year. They need fewer opportunities to interrupt a plan that was already working reasonably well before they touched it. A good system removes unnecessary decisions entirely. Automatic contributions remove the question of whether this month feels right. A broad index fund removes the pressure of guessing which manager or sector will outperform everyone else. A written allocation removes the temptation to rebuild your entire strategy every time the market has one bad week. None of this guarantees anything. Markets can disappoint for years. Inflation can hurt. Real emergencies can force unplanned decisions. But there's a real difference between risk you can't avoid and damage you're quietly inflicting on yourself. You can't control whether the market drops next month. You can control whether every drop becomes a referendum on your whole plan. You can't control whether some fund beats the index this year. You can control whether you chase it after the fact. That's the real lesson hiding inside the investor return gap most people have never heard mentioned by name. The market doesn't just test how smart you are, it tests something closer to your actual identity under pressure. Are you someone who needs to react the moment something moves? Who needs to avoid ever looking foolish? That need is exactly where the money quietly leaks out. A little during panic, a little during boredom. A little every single time an investor tries to improve a decent plan and accidentally makes it noticeably worse. The market can rise for decades while investors still miss part of it, stepping in and out of a moving elevator. The fix isn't becoming emotionless. Nobody manages real money without feeling something about it along the way. The fix is building a system that doesn't require your emotions to make the right call every single day, because the average investor doesn't only lose money when markets crash hard and headlines turn genuinely frightening. The average investor loses money when the market rises, and they simply weren't fully there to receive it. And here's the quiet irony underneath all of it. The market's long-term return isn't earned by predicting the future correctly. It's earned the far less glamorous way by staying present and simply surviving the same ordinary Tuesday repeatedly for decades. Keep thinking. Stick.